Welcome to YouTube. Okay, my videos. I'll give you an update on the market, what I think is going to happen for the future here. Let's take a look at it, what we got going. Okay, we got right now a very, very strong dollar. Okay, and the dollar, as you know, has been up over more than 20%. Okay, since 2014. That dollar going up, okay, really hurts our big companies. But you know what? Like IBM and Coke, and especially the Dow 30 companies, because most of them, I mean, you take for example Coke, you take IBM, you take Caterpillar, okay, tremendous amount of money, their revenue, about 75% of their revenue, 72% of the revenue comes from overseas. So when the dollar goes up, those stocks should be coming down. But they haven't been coming down. Why? Because the market has been front-loaded since 2008. And as long as we continue with this front loading of the stock market since 2008, okay, which now we have what we call a Trump rally, adding on to even more. Remember, we had this big drop here during the election, right? Boom, and they thought, okay, he was going to be president, market was going to drop. They were wrong. Big short covering came in. Okay, ran the market straight up like this, continue up and make all-time new highs up there, but it's not supported. Okay, there's nothing underneath here. You don't have under here earnings growth. There's no earnings growth holding it up. You don't. All you have is stock buybacks holding it up. That's all. There's one big stock buyback from right here, 2012 to right here. All stock buybacks. Okay, that's killing the country. They're killing our economy. Okay, you can't keep on borrowing money at 0%, and they just open up the window at the Fed. The hedge funds go in, the banks go in, all the big guys go in, they pick money up at zero and they pump it into the stock market. It doesn't help anybody but the very, very wealthy. But what it does do is help traders, that's for sure. Okay, so what's going to happen? Well, because there's nothing underneath this, and there's a big signal, a sell signal in this market, okay? And the sell signal comes in way of durable goods. I showed you, I think this last week, no, I don't think so. If you look at durable goods, what is durable goods? Durable goods is anything, a blue line, anything that you buy that lasts 3 years or longer. Durable goods is a great indicator as to looking forward as to the economy. You can see back here how the stock market and durable goods went hand in hand until we got to this point, and she split over this way, which means this bubble right here was stock buybacks of $125 billion a quarter right here. All this is a stock buybacks. And because of the zero money, okay, that the banks are willing the Fed's willing to give the CEOs, they're taking all that money and they're plowing it into their companies. So the reason why this is 25% shorter, meaning there's a 25% bubble in the stock market, is because the CEOs put money into their company to buy their own stock. They're not putting money in for productivity. Okay, there's no productivity, meaning if they buy new machinery and new technology, they produce more. They produce more, they're more efficient, their wages go up, and then we hire more people, and we have the multiplier effect. One job creates three. None of that's happening. So this is all big bubble right in here. All this is all a big bubble. And Trump's bubble is about the last 5% up in this area up in here. So we're setting up beautifully for a correction. Now, the stock market, I mean, they're saying they're going to raise interest rates. Well, there's a problem with raising interest rates. Okay, and the problem with raising interest rates is when you raise rates, the 20 trillion debt we have, okay, that 20 trillion in debt, Obama doubled it when we're paying 223 billion, okay, 223 billion in interest a year, okay. We add to that 117 billion, okay, another $117 billion. Not doing that very well, but you get my point, okay. We add 117 billion. There you go, you got it, right? So we add 117 billion dollars, okay, to this 223. That's for every quarter point. So every quarter point, our interest is going up. But wait a minute, our GDP is not going up. Yeah, but we just went to 3%. Let's average it over a year. Average over a year, the truth, the real truth, 1.8%. That over 3% we just got is a bunch of malarkey. Okay, they fudged the numbers. The reason why, because Obama's leaving office, and he had a title. He's the only president in history that would have been leaving office that never hit a 3% GDP, which made him the worst president in history. Okay, so they didn't want to let him leave hitting less than 3%. So they rigged the inventory in the GDP count. Okay, which is easy to do. They just say we have more inventory than they really have. So my whole point is you can't have a stock market continuing to rally, to keep going up, when you got we got durable goods divergence. Okay, so you got durable goods divergence going this way, following up the market, and then turns like this. Okay, and you got this big span in here. So this is going to correct, that's for sure. So what do we do now? Well, right now, the best thing to do is watch the stocks that have been going up when the dollar's going up, and they shouldn't be going up. I'll give you some good examples. Okay, take, for example, if we look now at a stock like, let me get rid of these here. We take a stock, for example, let's take Intel. Okay, Intel's been going up, but look, she's starting to break down now. See, see, that's the Trump rally. She's breaking down. Okay, and it's a good short, because anytime this red line is underneath this guy right here, this yellow line, it's a good short for a few days. Okay, called a swing trade. Beautiful short here, but you can see it's breaking down. Let's take another one. IBM. Okay, IBM has been going up. Are you kidding me? When you have the dollar going up, IBM is going up. What are you, nuts? It won't hold. A lot of it is short covering, because what's happening, the Europeans are dumping their euros, buying our dollars, creating a demand for dollars. As our dollars go up, Europeans take that as, oh, their economy's got to be better. Their economy looks real good, because what they're seeing is that when the dollar goes up, so doesn't the yield on the 10-year treasury, right? So when people get out of bonds, they sell bonds, the face of the bond value goes down, yields go up, sending a signal to everybody looking forward, the economy is going to be great in the next 6 to 12 months. Well, that's a bunch of malarkey. Why? Because the stock market, as we know it, went up for the wrong reasons. Okay, it's QE and then stock buybacks. So when you get a signal from the bond market where the yields are going up, okay, that's a big signal to Europe over here. Hey, start buying. We got a great economy. Now, that'd be okay if the stock market went up, not because of QE, not because of stock buybacks, but because of earnings growth. If you had earnings growth, that'd be great. But we have no earnings growth. If we had savings, that'd be great. Because from savings, okay, when you have good savings, that gives what? That gives money to the small businesses on Main Street to create 72% of our jobs. But they've been crowded out because Obama didn't want to create jobs. He wanted to create a bigger government. How do you create a bigger government? How do you finance it? You spend $27 million a second more than you take in. And so you have what they call deficit spending. So let's say you have $1 trillion deficit at the end of the year. So they spend $1 trillion more than they take in. So what do? They borrow, the government borrows the money. So they put out and say, we'll give everybody 2.5% interest on a 10-year treasury. Well, the guy that's sitting in the bank and he's got 0.25%, okay, at the bank, they're going to go and buy the treasury. That's called crowding out. So when they crowd out savings, we have a real problem, because savings, remember, is where the savings, that's where small businesses on Main Street go to their little community banks to borrow money. But, they can borrow money, all right. They crowded them out. But because because they don't have much money in savings, very little, their money is dropped, let's say, from here in savings down to here, because everybody's going and putting their money in treasuries, then small businesses, they go to the bank, and where they used to be able to get a loan for 5%, okay, or 4%, small business, they got to pay 8%. So they stop borrowing, which means they don't put, small businesses stop putting money into their businesses, okay, to create more jobs. And worse, Obama put in, to kill businesses, 20,000 regulations. That's right. That cost $100 billion a year on small business. They have to pay $100 billion a year, these 20,000 regulations. So between their interest rate goes up, which means the government is crowding them out because the savings banks or the banks don't have as much savings because everybody's going to treasuries, crowding them out. Then when they go to borrow money, they got to pay 8% instead of 5% because there's little money in the bank instead of this amount of money, and they crowd everybody out. That means we have no savings. And remember, for small businesses, that's where it starts. You got to go, and that's the access you have to capital. Next, he kills, even if they get access to capital, I mean, terrible access to capital, terrible high rates. Then he killed them by taking a loading on 20,000 new regulations. He just announced today for the end of the year, he's going to put on 20 regulations, which 17 of the 20 is going to cost small businesses, okay, $100 million a year, okay, $100 million in cost. So that's why more businesses are closing than opening, small businesses. So we can't grow the economy because we can't get enough good paying jobs, because the cure he needed, the cure to really get a good recovery was right here, small businesses. But he decided, the hell with that. You know, he's not going to go for the cure. He said, why would I go for the cure? What I'm trying to do, he says, is to create a big government. So if you're creating a big government, this is how he pays for it. So now what's happening is this will all correct. This market will start coming back because we can't grow the economy. That's the problem without small businesses. And nobody's talking about this, okay? And this is what's going to be the catalyst to start taking this down. The other thing is, remember, the government now is going to increase interest rates. Well, they're increasing interest rates, but wages aren't going up. Wages don't go up because savings don't go up. If savings don't go up, productivity doesn't go up. And from productivity is where we get wage increases, okay? So we don't have savings, we don't get productivity, we don't get our standard of living moving up. So what they're doing is going to raise interest rates. That means everybody's credit cards, their car loans, all the loans they have are all going to increase. So now they're saying, well, we're going to raise rates because Trump has a wonderful package that he's going to, a fiscal package where he's going to do all road work and all this stuff and all these programs. Yes, they're inflationary, but to cover inflation, you got to raise interest rates. You can't raise interest rates, not when there's not savings to create better wages or productivity. So this thing is so screwed up, okay? Everything we're seeing right now from here to here was all stock buybacks. This was a big QE lie, okay? And this stock buybacks. Now, if they raise this rates, which they're going in December, I think you're going to see a big correction come January. So that's my take on the market. We're way overpriced. At minimum, we're overpriced, as I show you, by at least the difference between where we are in durable goods sales and where the S&P is by 25%. And when this starts correcting, it's not going to be 25%. Panic sets in. Just always remember, you get a good economy from savings. And that's why the government or Obama decided to crowd out the small business. Okay, as long as he's offering 2.5% at treasuries, they're not going to go to the banks. If they go to the banks, they got to pay too much interest. They can't make it. And so therefore, he keep growing his government. That's the problem. So I think we got a good setup for a short-term pullback in this market between now and the mid part of January. I hope this helps you understand what's going on in the market. Remember, what creates good economies, okay, is savings, is then from savings, you have productivity, people start buying durable goods. That's how it works. That's how it works. But not this guy, okay? He doesn't want any capital investment by our CEOs. He doesn't want anything helping out small businesses, and the economy has paid for that. We'll see you on the charts. Join my gang, Phil's gang, where we have the best charting program in the world.